you all. Through this program, we have strived to keep you up to speed with the emerging business and economic geopolitical issues. We are happy that Leaders Speak program has resonated with the audience, and each session has enjoyed huge participation on the web and social media too. Though it is not the same as being together in the same room with all of you, this is still a pretty good way to meet the experts and discuss key issues. Today, we are privileged to have with us Dr. Hare Broadman, who heads the emerging markets practice of the Berkeley Research Group, and much more, which I'm going to leave to Mr. Kirloskar to introduce. But as he told me, he's a globalist, not just an American, so I have kept that in mind. And I believe he's also an Indophile and has written extensively about the race between India and China. Harry, it's great to have you with us, and I must thank Mr. Deepak Premnarayan for making this happen. Thank you so much, Harry, for agreeing to do this session. And with these brief words, over to you, Mr. Kirloskar.
Thank you, Rekha. Ladies and gentlemen, it's a great pleasure to have you and a very warm welcome to all of you in another edition of AIMA's Leader Speak program. The topic today is the race between Indian and Chinese corporates in international markets. Will the tortoise beat the hare? We're privileged to have Dr. Hare G. Broadman with us this evening. Dr. Broadman will talk about how the tortoise can beat the hare in the race between India and China. For many years, he has argued that India will overtake China, and he continues to back us to win this race. Dr. Broadman is partner, managing director, and chair of the emerging markets practice at the Berkeley Research Group. Dr. Broadman, it's a real pleasure to have you with us this evening. Thank you for agreeing to do this session with AIMA. As a veteran strategy consultant, you've been with PricewaterhouseCoopers, Albright Capital Management, and the World Bank. You've served as the Chief of Staff of the President's Council of Economic Advisors during the first Gulf War and advised many global companies, including IBM, GE, Coca-Cola, ExxonMobil, and Canon. You're also a prolific author, and your recent books include Africa's Silk Road, China and India's New Economic Frontier, From Disintegration to Reintegration, Russia and the former Soviet Union in the Global Economy, and the State as a shareholder, China's management of enterprise assets. Dr. Broadman, thank you for joining us and a very warm welcome to you. The questions to you and me will be in the chat box, as Rekha explained. I shall ask a few of my own before moving on to the audience's questions. Ladies and gentlemen, India versus China has been a running theme for the past decade and a half. In the mid-2000s, we caught up with China's rate of GDP growth, and the two countries had alternated in leading growth rates amongst big economies since then. In 1987, the GDP of both countries was nearly equal, but China took off thereafter. It opened up to foreign companies faster and put its population to work in factories with no qualms. Today, China's GDP is nearly 5 times that of ours. In 1990, our per capita GDP was higher than China's, but India now ranks 145th in the world, while China ranks 72nd. Despite starting late and growing democratically, we had been catching up. In fact, during the middle of the last decade, India overtook China's GDP growth rate and looked set to outrun China until our economy began to unravel a few years ago. India still has every chance of beating China on economic growth because it has all the basic ingredients: 1.4 billion people, with 2/3 of them in the working age bracket, an extensive education ecosystem, a decent base of mining and manufacturing, a strong and global services sector, a large technology and management talent pool, large foreign exchange reserves, and a capable security establishment. However, India has plenty of work to do to raise the standards of work and of living of its citizens to acceptable levels. The joke has been that India is a country of the future and will always be. But we need to prove that we can sustain high growth without becoming more like China. Dr. Broadman has followed the economic trajectories of India and China for a long time, and this is a great opportunity to learn about his prediction for this race. Over to you, Dr. Broadman.
Well, thank you very much, Rika, and um, the rest of the team for inviting me to speak. Indeed, I have been following the race, which I refer to as the tortoise and the hare, between India and China for some time. And it is correct that my bet ultimately, hopefully sooner rather than later, is on India rather than China. And maybe during the Q&A we can talk about that. I'm going to concentrate, as the title suggests, tonight on how Indian and Chinese firms operate in international markets. I want to start off by saying that I first traveled to India at the age of 26, just after I got my PhD. It was actually only my second trip outside of the United States, which was sort of interesting compared to my cohorts who had been widely traveled. So that was in 1984. And subsequently, the next year, I went to China for my first visit. And I was fascinated by both countries. I won't tell you which I enjoyed more, but you can probably guess from the tenor of my remarks. But as an economist focused on industrial organization and competition and trade and foreign investment, there was nothing like visiting the two largest economies and populations of the world then. And as I say, I've been following them ever since. This was the genesis of my interest in comparing the two economies, and in particular, given my interest in business, looking at how the businesses of those two countries operate. So much, to some extent within their domestic economies, but even more interestingly to me is outside of their home countries. I want to start off by giving you a sense of the analytical framework about how I think about these kinds of issues. Generally, I think the literature suggests, and my experience, I think, confirms, and most other economists' experience confirms, that firms who do well at home do well abroad. It's very odd to find, or very rare to find, a firm that does extraordinarily well abroad but does not do well at home. Now, well at home in China is somewhat different than well at home from a country like from India, and we can get into that. But ultimately, how well firms do at home is a function of how competitive the markets are at home. How much is there import competition and export competition? How much are there hard budget constraints, a euphemism that we economists use for the absence of subsidies and strong financial discipline? How much of the economies are rules-based? And to what extent is innovation a really important ingredient for how firms compete in their domestic economies? And then I would say also, because we are talking about two very large economies, both geographically and in terms of population, how much competition is mediated across the various cities and states and provinces within each of those economies? Because if you're ossified and you're not able to compete in neighboring markets or neighboring cities, there are barriers to entry. That obviously is going to inhibit how competitive you are, not just at home, but how competitive I believe you are abroad. And so I think this is why I look first and foremost at what's going on in the domestic economy. Well, the contrast between India and China using these various metrics, to me, is quite striking. China is an economy that is riddled with subsidies, both explicit and implicit. The banks lend money through round tripping to the state-owned enterprises, who in turn, frankly, do not pay the banks back, but the banks continue to lend because these are for state-owned banks. And they are not banks in any sort of commercial sense of the world, as I think most of us would agree. Imports are stymied in China. It's not to suggest that India does not have a protectionist heritage. It does, and we should be frank about that. And I think that's one area where serious reform could be undertaken, as we probably would all agree. But there are in China quite important regional blockages that certain state-owned enterprises, which dominate the economy of China as opposed to India, certain state-owned enterprises are not able to compete in neighboring provinces because the party has sort of carved up the geography about where competition can be mediated. And that, you'll see, in my view, conditions how the Chinese firms operate abroad. And I would say, probably quite importantly, there's not much of a rule of law within the Chinese economy, such as there is, I think, in India. Again, neither economy, including my own, the United States, is perfect. We have all imperfections, but I think there are these gross differences, if you will, between China and India that we have to take into account. Now, one of the important indicators about how competitive firms from countries are abroad is how much they are allowing foreign investment to come into their markets. Because if you can compete with foreigners on your home territory, you can certainly compete in foreign markets more easily and more effectively. So I did some calculations last night. I follow this, almost monthly. But the most recent numbers, when you look at the amount of inbound foreign direct investment divided by GDP, because we want to normalize for the size of the relative size of various economies. For China, that number, the FDI to GDP ratio, has actually been falling. Its peak was 6.3% in 1993, and last year, 2019, the latest year for which obviously data are available, the ratio was 1.1%. In the case of India, the flows between, or the relationship between foreign direct investment and GDP really has been much more variable than in the case of China. In India, the peak was 3.6% in 2018, just 2 years ago, not like China's, which was 6.2% in 93. And the lowest FDI to GDP ratio in India took place in 1991. But what's interesting is last year, in 2019, they were roughly equal. That is to say, whereas China had 1.1% FDI to GDP ratio, for India, it was 1.8%, actually surpassed China. And that, to me, that's a really important indicator. It's obviously 1 year, but the trend hopefully is not something that we should dismiss and look at quite carefully. Well, you might ask, beyond these numbers and the math behind them, is what role does politics at home, culture, and the rule of law, affect how firms compete in foreign markets? I think in the case of China and India, the answer to that question is they figure in big time. India is obviously a democratic country and has a lot of fervent and stimulation and innovation. And it is not a country that is importing its culture, if you will, or its politics. It is unlike China, which I think does export its culture and politics. And both countries are members of different types of coalitions, if you will. So for the case of China, historically, they tend to have operated, again, historically, in countries of a socialist nature. Now, of course, they're operating and investing in countries that are industrialized and quite competitive. And obviously, in terms of where they invest, the issue of Taiwan and how much countries recognize Taiwan is a very important indicator about where Chinese firm will do or will not do business. In the case of India, we don't have that veil. The only sort of important coalition, if you will, that India has is as a member of the Commonwealth countries, and that brings some benefits to it. But it's a very different club, if you will, than the club in which China is the member. Indeed, China is the chairman of its club. So I've been doing, based upon these kinds of issues and analysis, I've been following and doing research and writing quite heavily and speaking and advising to corporate boards and CEOs, both as clients and as members of corporate boards myself, how Chinese and Indian firms compete against one another or against third parties in different markets. And I look at not just the corporates, but also investment funds coming out of those markets, the private equity firms, and I say private equity in quotes in the case of China, because it's in my view, having spent a lot of time in China on the ground, finding a bona fide private equity firm in China is a very different exercise than finding a private equity firm in virtually every other market economy, certainly in India and certainly in the United States. But the bulk of my research and work advising clients has been on how Chinese and Indian firms compete and work in other advanced countries. But what I find particularly interesting is some work I did several years ago, and which is my passion, which is emerging markets, and hence the practice that I run at BRG, Berkeley Research Group, is how do Indian and Chinese firms compete and operate in emerging markets. And so the euphemism is how do Southern firms from the South, India and China, compete against one another in other Southern countries. And so I have been fascinated looking at this question, like-minded countries, if you will, both of all emerging markets, how do they invest in each other and what's their behavior? To me, that allows for controlling for lots of other differences with one fell swoop. And obviously, this is one particular lens. Indian firms and Chinese firms in different ways have been very successful investing and trading in northern countries and the advanced countries, but I want to focus for the moment on how they are doing in emerging markets, so-called, as I say, South-South investment in trade. So several years ago, and this is when Deepak and I first met each other, I wrote a book while at the World Bank called Africa's Silk Road. And it was a pretty serious piece of work that looked empirically at how Chinese and Indian firms were behaving and operating on the African continent. And in the book, I looked at 450 firms at the firm level, collecting data through quantitative surveys, and also conducting case studies, very in-depth case studies, where I would spend a half a day with the CEO. And I did this for about 25 firms. This book took about a year to write. And the reason that I married both the quantitative survey work to be able to do econometric and statistical exercises with the case study work is I wanted to combine the quantitative and qualitative aspects, because I believe as an economist, you don't get the full story by looking at just either of those dimensions in isolation. So as I say, we looked at 450 firms in the quantitative exercise, and I did about 25 case studies talking to CEOs of both Chinese firms and Indian firms across Africa. And they were all in the same sector. We selected 4 sectors, so we controlled for sector differences. We concentrated on 5 pretty significant countries in Africa. So we tried to really control for other differences as part of the analytical framework so that we could come up with, I think, some economically meaningful analysis and conclusions. Well, it turns out that this book, Africa's Silk Road, which was in the World Bank terminology, a standalone book. It was not a book that was coming out of a particular project or a research endeavor. Rather, it was my own doing, turned out to be the best-selling book in the World Bank for that year. It was published in 2018. I'm sure some of the reason why it was a best-selling book was the title was very good. I was very proud of thinking about the title. I woke up one evening and turned to my wife and I said, I got a title, you know. But more importantly, when I wrote the book for the World Bank, like some other books I did for them on Russia, which was mentioned, and China, I wanted the bank to not charge for the book in emerging markets, because that's where the readership would be. So the book was, and frankly still is, for free, a PDF version, because my aim was to get the book out there so people could read it. So when I say best-selling, maybe we should put best-selling in quotes. It's in some cases, the books were downloaded for free. But let me tell you what the results of the analysis was. And I've done some updating on these numbers in subsequent years. And most of the conclusions and findings hold to this day. There are certainly some similarities in the way that Chinese and Indian firms operate in Africa. Again, using Africa as an example here of a set of emerging markets. Africa, of course, is a continent, it's not a country. We have to keep that in mind. One of the similarities is relative to European firms and US firms and African firms, which were the control groups studied in the book. Chinese and Indian firms tended to climb the value chain in exports out of Africa. And that is actually a really important finding, because they have been helping Africa get out of the trap of exporting raw commodities. And so if you compare the average type of good or product that is being exported out of these African countries by Chinese and Indian firms, they tend to be more processed and create more value added on the continent prior to their being exported. Well, they also turn out to have a lot of horizontal integration across different countries in Africa, which is again very important. This comes from emerging market firms understanding how their own home environments dictate and condition how they look at a foreign environment. So they tended to operate in different horizontal markets across Africa, which is, I say, important, because one of the curses of Africa is that it's a set of a large number of countries that are landlocked, but they are not integrated. And that, of course, is the genesis for the current Africa Continental Free Trade Agreement, is to try to create an integrated market. And I think India and Chinese firms have been actually very important ingredients in furthering that integration. And it also turns out that not only are the Indian and Chinese firms able to help Africans climb the value chains before exporting, in the places in which they are investing, those markets tend to be more export intensive, because India and China, compared to the average, in quotes, African country, are integrated into the world market. So they both have been really significant generators of exports out of Africa. Well, so much for the similarities. I think what is particularly interesting is what the differences are. And these differences are quite striking. And to be honest with you, when you look at how Chinese and Indian firms are operating in other markets around the world, particularly other emerging markets, but not necessarily only those, these differences tend to be replicated in other markets. So again, I think of Africa as just a case study here, but it has extraordinarily important implications in other geographies where we're comparing how Chinese and Indian firms are competing in those markets, and not just competing against each other, but competing against world-class firms from the advanced countries. So with few exceptions, Chinese firms in Africa, like at home, are state-owned enterprises, and they tend to be large state-owned enterprises. In contrast, the typical Indian firm operating in Africa and in other emerging markets tend to be private, family-run, but they're generally not state-owned enterprises, because state-owned enterprises are not the backbone of the Indian economy. And that implies lots of differences in competitive strategy in foreign markets when you have a SOE competing against a firm that is privately or family owned. One of the implications of that is because Chinese firms tend to be state-owned enterprises operating abroad, particularly in Africa, they get dictates from home as to which markets they can enter or should enter into. And so you find that the African market is segmented. So a steel company coming out of one province in China is not going to be competing with a steel company coming out of another province of China, because ultimately, of course, they're all part of the Communist Party. The Communist Party is not necessarily the greatest run organization, but one thing they do well is they carve up where their firms are going to be operating abroad so as to minimize competition against one another. So you find a lot of segmentation between Chinese firms operating in Africa, but you don't find that at all in the case of Indian firms. Indian firms are quite happy to compete with one another in third countries, just like they do at home. The firms from China also tend to be, as I mentioned before, quite large, whereas in the case of India, the firms that are operating in Africa are a much varied size and scale. Yes, to be sure, there are some very large Indian firms operating in Africa, but you do see a lot of so-called mom and pop stores throughout Africa. There is some of that in the case of China, but these tend to be appendages to the SOEs, and they tend to be catering more to the SOEs in the African countries than the African population per se. The way that Indian and Chinese firms enter into Africa is also very interesting. Indian firms are not afraid to acquire existing African firms or European firms or US subsidiaries, whereas virtually all of the Chinese firms entering into Africa are de novo. They're greenfield investments. And again, that's a very different business strategy, if you will, that distinguishes how India and China operate abroad. Probably one of the most interesting findings of the work, and it's still very much true today, is Chinese firms tend to be extraordinarily vertically integrated as they operate in Africa. That is to say, rather than buy their inputs on the open market, if you will, whether it's merchandise or whether it's hiring workers, they're quite risk averse. And so much of their inputs are being shipped through their internal channels from China or from other countries where a Chinese company might be making something. So there is a high degree of vertical integration on the part of Chinese companies. In the case of Indian firms, they are less timid about procuring supplies on the open market through local products, workers, and the like. And in my view, this really is quite emblematic of the different risk profiles and risk aversion profiles between Chinese firms on the one hand and Indian firms on the other. Indian firms tend to be much greater risk takers than Chinese firms. And again, owing to who the owners are of these firms, you would not be surprised to see these differences. In the case of workers, we see many stories in the press about lots of workers in Chinese firms coming from China, doing their time. It's almost like the American Foreign Service or maybe the Indian Foreign Service, doing their time working in a state of enterprise in Africa, and then going back home to China. That is indeed true, but again, it's part of the risk aversion factor, I think, that the Chinese have. Now, obviously, Indian firms will also employ Indians, but they are far more receptive about hiring local workers as part of their enterprise on the ground in Africa and indeed in other countries in which they work. And that brings me to another finding, again, I think, which is part of a consistent story, is that Indians in Africa are quite infiltrating in a good way the socioeconomic fabric of Indian society. Whereas the Chinese, if one can generalize, tend to operate as in enclaves. And so you find Chinese communities sometimes within the confines of the state-owned enterprise plant where they are living, and they rarely mix with Africans, not because of racist issues, although I'm not ruling that out on the part of any society, but I think they feel more comfortable socializing among themselves. In the case of India, that you find just the opposite. Indians have, as I say, entered into the socioeconomic fabric in African countries. Part of that is as a historical matter because India has a longer history living and working. Indians have a longer history of living and working on the continent than Chinese firms. But it also shows that there's a very different philosophy and culture, as I mentioned at the outset, that the Indians bring to the foreign markets in which they work. And one of the variables that we measured in the study was, we asked the CEOs of the 450 firms, how many of you have African passports? Because we wanted to get a quantitative indicator rather than a perception. How much do you feel like you're an African, right? And it turned out in both cases, India and China, the number of CEOs that had African passports was very low, but the ratio was extraordinarily different. By far, Indians had far more African passports, in part from marriage, but also because they decided to become citizens in Africa. It was rarely the case in China that you find that. And to me, looking at quantitative indicators like that, rather than perception-based indexes, tells you a lot about how people are operating and how businesses are conducting business in foreign markets. Another sort of difference is because the Chinese firms are these state-owned enterprises, they are quite active in state procurement bids in the African countries, whereas Indian firms do that, but nothing quite like the Chinese firms do. And you would not be surprised to learn that in most of the bids in which Chinese state-owned enterprises participate in in Africa, they win. Well, why do they win? In part because they're subsidized and they're able to strike a much lower price. They're subsidized by their home government, and so they're able to outbid virtually every other competitor. And one of the stories that came out of the case studies was, this was a construction firm in Africa, I think it was in Kenya. He has decided with his company to actually team up with the Chinese because he said, well, I'd much rather be part of a Chinese procurement bid if they're going to be subsidizing us so we can win the bid. And he said to me, he said, if you can't beat them, join them. And so what you find is that some of the African firms in this public procurement market have realized, well, we better try not to outcompete with China because we're never going to do so. We might as well engage in JVs with them, which is what they have done. And then the final thing I would say is part of the case studies. As I say, we interviewed many CEOs, and I also asked the question, how do you see your firm as part of African society? How do you brand yourself in the local market? And I would say, the vast majority of the Indian CEOs that we interviewed said, we want to be seen as an African firm. That is a strikingly different response than what we got from the plant managers and the CEOs of the Chinese firms operating in Africa. So that's sort of, in a nutshell, a review of the findings that was in this book, Africa's Silk Road, and I say have been updated since. And I think it's a story that you can replicate, not exactly the same, but replicate in other markets, and tells you a lot about the different ways in which Indian firms and Chinese firms compete outside of their home markets. So with that, I'll entertain questions or comments. And thank you again for your time.
Thank you. Thank you, Dr. Broadman. We're glad to have you rooting for us in this race, if I could say that. I mean, there was a lot of information over there. And something that struck me was you said that China is riddled with subsidies. I remember many years ago, my friends telling me that Chinese companies do not need to consider interest or depreciation in their costing. And what you're saying actually does whatever they were saying, it seems was true. So let me begin the question and answer session by asking you the first question. And one of the things I mentioned when I spoke was that we need to do a lot ourselves to improve our economy. So India needs, there are a lot of questions on China, I'm sure, but let me start with a question on India. India needs a huge amount of foreign investment and money to grow its physical infrastructure in order to compete globally. What, in your view, should we do to make India more attractive to foreigners in order to win this race? Because it's going to be an all-out effort, so we can't just depend on ourselves. So what do you think we should do to make ourselves more attractive to foreigners to win this race, is my question.
Yeah, so I mean, obviously, Mr. Modi has begun to open up some of those procurement markets, particularly in rail and some other parts of infrastructure. As I said in the outset, I don't think we should be shy about talking about the amount of protectionism in the part of Indian markets. Now, it's not as there's not protectionism in the United States, which there is, particularly under this administration. I'm not, I don't see the world through rose-colored glasses. But I think one of the things, and we've also been, frankly, struggling with infrastructure, clearly. I think, opening up the market for competition by other suppliers is really important. And it does not mean that the foreign suppliers necessarily should come in by themselves. I think there's a lot to be said for entering into procurement bids if these are funded by either the province or the central government, to come in with Indian partners. And I think that's really important. But I think the number of sectors where one can do that in India is more limited, I think, than they should be. And I think, again, I think the U.S. does have a little bit more open procurement in certain areas of infrastructure. Again, our investment has not been what it should be. But I think when you look around the world, infrastructure is obviously a very sensitive sector. But I think, as part of this race between India and China, particularly when you have spatially large economies like a China, like in India, you've got to have infrastructure, because otherwise you're not going to be realizing these economies of scale and economies of scope. And I just don't see, why there is hesitancy to allow for greater joint bidding, bringing in foreign partners, if you will. Obviously, you're not going to bring in foreign partners who don't qualify, who don't have strong track records. But one of the major impediments to India's growth, there are many, just as there are in the US and China and so forth. But one of the major impediments is the lack of an integrated infrastructure throughout the country, so that goods can move freely and with great fluidity. And so I think opening up that market far more than it has been, both on the actual delivery mode, but also on the actual, putting in place highways and rails and airports and the like. So I think, to me, you've hit the nail on the head as on one of the major constraints on Indian growth. And if I were the prime minister, this would be one of my most important policies.
Okay, thank you for answering my question. I run a company that makes pumps, and for some reason, centrifugal pumps for water supply and things like that. And I feel that India is far more open than the US is with their Make in the US or America First policy. Anyway, so much for me. Mr. Prem Narayan wants to ask a question, so I'll let him have the floor.
Sure.
Thanks, Sanjay. Hare, nice to see you again. Yeah. And if I might come back, look, you have been saying this very strongly for the last several years, that the financial system in China, particularly the state-owned banks and other state-owned companies, have got major issues within them. And it's a matter of time before, if one major one collapses, there's going to be a cascading effect. What one hears today is like the 2015 crash of the stock market. There is a similar infusion happening by the government very strongly into the stock market today. And the growth figures that are coming, I don't know, because that's an area of your expertise, how authentic are they? But as an Indian, if I might just pose another thing, to me, the bullying that's happening is the union that's being formed globally, whether it's Huawei or whether it's other Chinese products, is how do you see that sustaining itself? Because you've been a proponent for multilateral versus bilateral, etc. Now, these are my two questions to you, Hare.
Well, thank you, Deepak, for two very simple questions, as usual. So you're quite right about the soft underbelly of the Chinese economy being the bank enterprise nexus. And given that they're both owned by the state, that not only has a chilling effect on the state of enterprises and the banks, frankly, from being competitive, but importantly, what it does is it chills out the bona fide non-state sector, which is the Chinese euphemism of the private sector, getting the upper hand in the Chinese economy. And that's just not part of the Communist Party's plan. So I think until we deal with that issue, I just don't see much of a change, except, and I think this is what you were hinting at, and really goes back to our own discussions, is, don't be surprised if there is a bank run in China. And I think this is what is uppermost in the Chinese leadership mind in terms of fear. As we know, the Chinese care most about social stability, but as soon as there's any hint of a loss of confidence, and the Chinese, and we've seen some news reports about this recently, and the Chinese say, you know what, we're going to take our money out of the banks and put them under the mattress or put them, someplace else. That's where I think you're going to see, the rubber meets the road, and we're going to have a very serious problem in Chinese banks. And obviously, I think it's going to cascade internationally. And when we talk about the equity exchanges, and notice I'm not using the word stock market. The Chinese equity exchanges are not stock markets in any meaningful sense of the word. I don't use the word market. These are not exchanges that are governed by the free flow of supply and demand. And I'll give you one example of that. As you point out, and as I've discussed before, when the stock exchange in China had a couple of rough patches over the last several years, what happened? The government came in and bailed out investors. Now, the typical investor in China, so I understand, and from the pictures, tend to be grandmothers, people who they think it's a lottery. But it's not a lottery, because in a lottery you buy a ticket, and if you don't win, you go home and you lick your wounds. But in the case of China, they don't want any social upheaval. So what the Chinese have done is created moral hazard. And so now, Chinese investors who play in the stock exchange realize, well, you know what, there's no downside, because I have full faith that the government will come and bail me out. That is, again, that the Chinese can ride the bicycle for just so long. And I think that's a very dangerous policy. In terms of, the rest of the world thinking about China, both in terms of investment and trade policy, you're quite right. I think, and this goes, I think, to to the problem that we have with the WTO not being something that the US, which was sort of one of the arch creators, has largely abandoned. Now, hopefully, if we have a change in administration at the end of this year, we'll have a different attitude. But I think the problem has been that we, the US, but other countries as well, have taken on China bilaterally. And part of that is because they think, well, China's a very large economy, and it's too complicated to bring other parties to the table. But that's precisely when you should be bringing other parties to the table. And I've long argued that when you look at the WTO accession agreement that China signed in 2001, when they finally were admitted to the WTO, and I've looked at this agreement quite a number of times, this is a legal agreement, and the Chinese promised that they would, impart certain reforms quite spelled out. You go through that agreement, and they have not put in place those reforms. And so my view is, if we want to take the WTO seriously and have the rest of the world take the WTO seriously, this is the time to bring a huge dispute case to China through the WTO mechanism to say, you know what, you can have whatever economy you want to have, but you cannot have your cake and eat it too. You cannot have the preferences of being a WTO member unless and until you actually put in place these reforms. So it's up to you, China, what do you want? Because right now, you're going to have to exit the WTO. If you want to renegotiate your accession agreement multilaterally, we're all for that. But that to me is the single most important oversight that, again, not just the US, but largely the US has been the champion of. And I think until we deal with China multilaterally, the big trading powers of the world, the Indias, the European Union, the Australians, the Canadians, the Brazilians, China's just going to continue to play this game, and it's our world, right? It's up to us to figure out what we want to do. But I think continuing down this bilateral path, such as Mr. Trump has done, is not going to solve anything.
Okay, thank you. The first question from the audience, Mr. Jagdish Khatri, says, as per reports in 2019, the foreign debt of China was at 317% of its GDP. Do you think China would be able to survive this for long?
Well, again, one cannot think of these numbers through the lens of a market economy. I think the saving grace in the case of China is the shoe is pinching because the debt is increasingly foreign, and bondholders who are lending money to China, again, if they act in a multilateral fashion, the chicken will come home to roost. But again, I think that the question is, we, the rest of the world, but for China, have supported this addiction, and the question is, look at the present value of the costs of dealing with the problem now versus the present value of the cost of waiting, several years down the road. So, I think that as long as the rest of the world allows China to get away with it and continues to lend money and China's debt to GDP ratio climbs, they're going to continue to do so. But as I said, in answer to Deepak's question, at some point in time, the bicycle is just going to run out of space. And I think that point in time is going to be when there is social unrest in China. And, the state-owned enterprises can do only just so much. And I think, one of the issues, and this came from my most recent visit to China just prior to the pandemic, is when you speak to the professionals and the people who really understand the economic workings of industry in China, people with whom I used to work when I was at the World Bank, they think of Mr. Xi as certainly me and many of us in the US think about Mr. Trump. And there's a lot of resentment. And that's why, frankly, Mr. Xi is tightening his grip. So it's a long-winded answer to your question about debt, but I think thinking about these questions with respect to China simply from a financial lens, I don't think you're going to get to the guts of the problem. At least that's my view.
Okay. Someone else wants your view. Mr. Muhammad Anis Ansari says there's no direct relationship between democracy and economic growth. It is economic exclusion or monopolies which impede economic growth as it retards competition. What is your take?
Well, I think we're on the same line here. I mean, I think the difference is that we have seen that one can have short run, maybe medium run growth in the absence of democracy. But at some point in time, as the population becomes more educated, more sophisticated, you're gonna just run out of runway. And let me just give you one example, which I forgot to mention in my remarks, about how I see the Indians versus the Chinese in terms of innovation on the ground, and their understanding about consumer behavior, such as we're talking about at this very moment. So one of the case studies that I undertook was looking at the blanket market selling at kiosks in South Africa. And what we found was that the Chinese brought in lots of very, very inexpensive blankets, sold them on the kiosks in South Africa, and the African consumers bought them like crazy because they were very inexpensive. The Chinese had African designs and so forth. Well, what happened was, as the blankets got dirty and the purchasers washed them, they shrank, and then the dye ran out of them, and they became known euphemistically in this market as the Chinese wash and cry blankets. Well, in come the Indians, and they say, there's a market opportunity for us. So what do the Indians do? They begin to produce higher quality blankets, still very inexpensive, not like the European imports, but better quality. They didn't shrink, the dye didn't run out, and lo and behold, the African consumers, these are very, very poor consumers, shifted over to buy. They were willing to pay more for a higher quality product. This story to me is extremely important as an illustration about how the free market works for people to make intelligent decisions and get smarter and wealthier. And I think the Indians understand that, frankly, far more than the Chinese do.
Well, I'm an engineer and not a politician or an economist, but you can see things changing in Singapore as well, which is like China, but outside China. And I think in the last election, the opposition got far more seats, and the ruling party got, so, as people are turning richer, they do want political freedom as well.
Yep.
The next question is, will opening up FDI like China lead India to erosion of India's wealth? Before you answer it, maybe even as an engineer, I could answer this, that FDI has always improved the wealth or increased the wealth, whether you see Europe after the Marshall Plan or Southeast Asia or even China. And at least my belief is opening up to FDI will increase our wealth. But, the question is to you.
So I'm very sensitive to this question, and whether it's FDI or whether it's imports on the trade side. The issue is that if you believe, as I do, that free flows of trade and investment are determinants of growth and prosperity, you also need to understand that there's a short run and a long run lens that you have to have on this. And the short run lens is, as imports or foreign direct investment comes in, and it becomes successful in the sense that the consumers buy the products, whether it's a factory buying steel or whether it's someone buying a blanket, what they are doing is they are displacing the incumbent providers because they find that whatever is being supplied through foreign means, whether it's trade or investment, is a superior product at a better price to quality ratio. but that's a signal. That's what we mean by competition. It's a signal to the incumbent provider to get off his behind or her behind and start making things better. And if they don't, this is what allows competition to come in. Now, there is a role for government, obviously. If it's a result of policy that has allowed this to take place, we need to think about the short run churning costs. And one of the things, frankly, that the US has not done well, and many countries don't do very well, is how do you ease that transition? How do you ease the factory that was making something that no one wants to buy? Well, we don't want social unrest either. So the question is, how do you support a transition to another job or to another location? So that's why I think the issue of competition is a rich one, and it's an interdisciplinary lens that one has to bring to bear to look at it.
Okay, thank you. Mr. Joshi wants to know what role do you see Indian startup ecosystem playing in global markets, and what opportunities can these startups explore in emerging markets?
Well, as I said, I think the culture of VC, venture capital, and startups in India is extraordinarily healthy, both for India and for the world. And it's becoming contagious. I think the Indians are great generators of this kind of enthusiasm and work and operations, not just in India, but in other countries, including frankly, on the African continent. So I think the last thing that we want to nip in the bud, at least as an economist and as a policymaker and as a board director, is the spirit of innovation and the spirit of people placing bets on new ideas and new investments. And so I think this is a very different culture that India has, frankly, than China has. And I'm painting with a broad brush, and I'm sure my Chinese friends will tell me that I am. But I think in the time that we have, I think you find that the culture of innovation and startups in India has a much longer history. Now, obviously, in the case of China, there are some incredibly important inventions, to be sure. But I think those are the exceptions, frankly, than the rule, and I would say it's really in the DNA of Indians, right, to operate in these terms. And I hope it becomes more and more contagious. Frankly, I hope it catches on in the United States more than it has.
Okay, I'm just choosing questions now because I think we are running out of time, and you have to tell me which one is the last question. Mr. Debayan Bose says, if we consider the Indian pharmaceutical industry, which is doing well in the global competitive scale, a major chunk of APIs, or active pharmaceutical ingredients, are imported from China, approximately 68%. Do you believe that India should continue to have such dependency on China for mutual economic benefits, or should the Indian pharmaceutical industry think about self-sufficiency in the long term for economic and business leverage? And this more so in the light of our Prime Minister's Atmanirbhar or self-reliance program.
Well, I understand the political slogan, and I understand the importance of self-reliance. It's not unique to India, but as I said in the answer to the previous question, there's a balance to be struck, and the notion that there's a quote dependence on China. Many countries are economically dependent on China, but in a world of freedom, those choices are being made unless they're being dictated by governments. And so I think it's up to businesses to make decisions by themselves about what's in their best interest, not just for their workers and management, but for their shareholders and stakeholders. So I think businesses have I'm a big champion for businesses to stand up what they think is the right thing to do. I believe that businesses who are smart, for instance, will will embody ESG types of principles as part of their operation. It doesn't necessarily have to be demanded of them. So I think, you know, what we're talking about here is what's the smart business person and what's not the smart business person, and how does he or she make the trade-offs between the short run gains and the long run gains. So that's a little bit of a long-winded answer to a question about pharmaceuticals, but I think I'm using pharmaceuticals just as a case in point in my answer.
You have to tell me which is the last question, because I believe this was between 6 and 7 over here.
I'm willing to do one more. If Rika says one more, we can do one more.
Okay. She's on mute, but I'll take that as one more. I mean, she might not.
Okay.
One more. So one question on soft power, right? He says, Mr. Avik Sarkar says, it's been a very interesting talk. The passport and cultural mix-up points at the Indian soft power. Can you please suggest how soft power can be used for economic growth?
Well, I think it can be used both for good and for bad for economic growth, and I think the Indians, frankly, are way ahead in the game of using soft power than the Chinese, and I think again it's a question of self-interest, but it's also a question of, you know, in the foreign markets in which that soft power is being exercised, that the stakeholders, to use that word, who are affected by that soft power have the ability to speak up. Now that is not going to be a function of what the Indians or the foreign investor does. It has the question of what's in the local fabric of the country in question. And we are obviously in the US are having this incredibly hot debate about China in the US. Now, some of it's soft power, but some of it's rather hard power. But I think, I think to be able to have society, the economic actors, businesses, workers, to be able, and consumers have a vibrant voice, and making sure that the government allows those vibrant voices to be heard is really the answer.
You know, my firm also worked in China, and there were many instances where the government's ministers or heads of government would tell us that it's far easier to work with Indian firms, because even if you get money from the Indian government under line of credit or buyer's credit or whatever, Indian firms still make a point to use as much African labor or introduce African firms into the products or the projects that they do. Unlike Chinese firms, which bring in all materials, which bring in people and everything else. So thank you for a very interesting talk this morning for you. The rest of us are getting ready for the weekend, but you covered a huge range of topics, and all of them were very interesting, very different insights. So thank you, Deepak, also for getting Dr. Broadman to us. And with that, our Director General, Rekha Sethi, always has the last word, so I'll let her have it again.
Thank you, Mr. Kirloskar, for letting me always have the last word. That's good for me. Thank you so much, Hare. I think it was a wonderful session. Many questions in the chat. Unfortunately, we've run out of time and we won't be able to take most of them. But I think it was a great session, and you covered a whole lot from on India and China. We look forward to having you with us for the National Management Convention, and perhaps a more vibrant debate with you and some of the other speakers there. And I look forward to keeping in touch with you. And for all the delegates, I'm sorry we were not able to take all the questions, but maybe Hare will do another session for us soon. So thank you very much. Thanks, Hare.
It was a pleasure.
Thank you. And thank you, everybody. Thanks so much for joining us once again for the Leaders Speak session.
Thank you.
Good night and have a good evening.
Bye-bye.
Bye-bye.